how much house can you really afford based on your salary? In this video, we break down realistic housing budgets by income level, including what you can afford at $40,000, $60,000, $100,000, and beyond. We'll cover mortgage payments, property taxes, insurance, debt-to-income ratios, hidden homeownership costs, and the biggest mistakes people make when buying too much house. If you want to buy smarter, avoid becoming house poor, and understand what your paycheck can realistically support. This video will help you make a better financial decision. If you make a certain salary, how much house can you actually afford? Not what the bank says you can afford, but what makes sense in real life, because those are two completely different numbers, and that's where a lot of people get into trouble. They go online, use a mortgage calculator, get pre-approved for a number that looks way bigger than expected, and then assume that means they're financially safe to buy at that price. But just because you can get approved for a house does not mean you should buy that house. So in this video, I want to break down how much housing you can realistically afford based on salary, what the monthly payment should look like, and how to avoid becoming house poor. Because that is one of the fastest ways to feel broke, even with a decent income. Let's start with the first rule. Housing affordability is not about the home price. It's about the monthly payment. That payment includes way more than just the mortgage. You've got principal, interest, property taxes, homeowners insurance, maintenance, utilities, possibly HOA fees, and if your down payment is small enough, mortgage insurance too. So when someone says, I can afford a $500,000 house, that doesn't really mean anything unless you know what the full monthly cost looks like. Now, a common rule lenders use is the 28-36 rule. That means no more than 28% of your gross monthly income should go toward housing, and no more than 36% should go toward all debt combined, including credit cards, car loans, student loans, and your mortgage. So let's translate that into salary examples. If you make $50,000 a year, your gross monthly income is about $4,167. Using the 28% rule, your housing payment should be around $1,167 a month or less. That's not your dream house budget. That's your safer range. Depending on interest rates, taxes, and insurance where you live, that could mean a home price somewhere around the low to mid $100,000, maybe higher with a larger down payment, or maybe lower in high-tax states. If you make $75,000 a year, your monthly gross income is about $6,250. At 28%, your housing budget is around $1,750 per month. That gives you more flexibility, but again, you still need to factor in everything else. If you already have a car payment and student loans, your true affordable number could be a lot lower. At $100,000 a year, your monthly gross is about $8,333. So 28% gives you a housing target around $2,333 per month. On paper, that sounds pretty solid. But if you stretch to that number and you live in an area with high property taxes, expensive insurance, or rising maintenance costs, you can still easily feel squeezed. And that's the biggest trap. People calculate affordability based on gross income, but they live off net income. That's the money left after taxes, retirement contributions, health insurance, and everything else comes out of your paycheck. So if you make $100,000 a year, maybe your take-home pay is closer to $6,000 to $6,500 a month, depending on your state and deductions. Suddenly, a $2,300 housing payment doesn't feel light anymore. Add utilities, repairs, groceries, transportation, and normal life expenses, and you realize pretty quickly why so many homeowners feel stressed. That's why I think a better approach is this. Instead of asking what house price you can afford, ask what monthly payment still lets you invest, save, travel, and breathe. Because if your house eats up all your cash flow, you don't own the house owns you. And then there's maintenance, which people constantly underestimate. A good general rule is to budget about 1% of the home value per year for maintenance, though older homes can cost much more. On a $400,000 house, that's $4,000 a year, or roughly another $333 a month, and that's before the water heater breaks, the roof leaks, or the HVAC system decides to quit in the middle of summer. This is why being conservative matters. Let's say the bank approves you for a $600,000 home. That sounds exciting. It feels like a win. But if your budget feels comfortable at $450,000, that lower number is probably the smarter move. Just because you have borrowing power doesn't mean you should use all of it. In fact, one of the best financial positions you can be in is owning less house than you can technically afford. That gives you margin. Margin gives you peace, and peace gives you options. You can invest more. You can handle emergencies, you can survive job changes, you can say yes to opportunities without panicking over every monthly bill. Now, if you're trying to buy in an expensive market, I get it. Sometimes even modest homes are priced aggressively. In that case, you have a few levers you can pull: increase your down payment, reduce other debt, improve your credit score for a better rate, consider a smaller property, or buy in a lower cost area if that's realistic for your lifestyle. But what you don't want to do is emotionally justify a bad financial decision just because real estate always goes up or I'll grow into the payment. Maybe you will, maybe you won't. And betting your future on that assumption can get dangerous fast. The better move is simple: buy the house that fits your life now, not the one that stretches your identity. Because financial freedom is not about impressing people with a bigger front door. It's about having enough room in your budget to actually enjoy your life. So how much housing can you actually afford by salary? Probably less than the bank says, and ideally less than your ego wants. If you can keep your housing payment conservative, avoid heavy debt, and leave room for investing in unexpected expenses, you're not just buying a home, you're building a stable financial foundation. And in the long run, that's worth a lot more than granite countertops and an extra 500 square feet. How much house can you actually afford based on your salary? This is one of those questions that sounds simple, but the answer depends on how honest you're willing to be with your budget. Because if we're talking about what a lender may approve you for, that number is usually much higher than what's financially comfortable. And if we're talking about what you can afford without sacrificing your ability to save, invest, and enjoy your life, the number is usually lower than most people expect. So let's break this down by salary. First, if you make $40,000 a year, your gross monthly income is roughly $3,333. Using the classic 28% housing rule, your maximum monthly housing payment should be around $933. That includes mortgage, taxes, insurance, and any HOA fees. Realistically, that means homeownership may be tough in many markets unless you have a substantial down payment, low taxes, or you're buying in a lower cost area. For a lot of people at this income, renting below their means while building savings might actually be the stronger move. At $60,000 a year, your gross monthly income is about $5,000. That gives you a target housing budget around $1,400 per month. This is where some buyers start to feel like homeownership is possible, but it still depends heavily on debt. If you've got a car payment, credit card balances, or student loans, your flexibility shrinks fast. The salary alone doesn't tell the whole story. Your obligations matter just as much. At $80,000 a year, you're at about $6,667 gross per month. 28% of that is around $1,867. That can open the door to more decent housing options, especially if you have good credit and at least some down payment saved. But even here, there's a danger in assuming that if the monthly payment technically works, you're good. Because once you own a home, the costs don't stop at closing. You have repairs, you have furnishing costs, you have utility bills that are often higher than expected, you have random expenses that show up when you least want them to. So if all of your money goes into the payment, you're probably still overextending. Now let's move to $100,000 a year. Gross monthly income is about $8,333, and 28% gives you roughly $2,333 a month for housing. This is a strong income in many parts of the country, but again, context matters. In a high-cost city, that might still feel tight. In a more affordable area, that could give you plenty of room. But I'd still caution against maxing out your budget just because the math works. At $150,000 a year, gross monthly income is about $12,500. That means a housing target around $3,500 per month. At this level, a lot of people can comfortably own a home, but only if lifestyle inflation hasn't already eaten the rest of their money. If your income goes up and your spending goes up at the same pace, you don't actually get wealthier. You just get more expensive. And that's something home buyers often ignore. Affordability is not just about what you earn. It's about what you keep. Now, here's the part that matters most. Lenders use gross income, but you spend net income. So let's say someone makes $80,000 a year. After taxes and deductions, maybe they take home around $5,000 a month. If their housing payment is $1,850, that's already a huge chunk of what actually lands in their bank account. Add groceries, transportation, savings, entertainment, and maintenance, and suddenly things feel very tight. That's why I think the best affordability rule is not what's the highest payment I can survive, but what payment still lets me build wealth. If your housing payment is so high that you can't invest, can't save an emergency fund, and can't handle basic repairs without using credit cards, then the house is too expensive. Period. Another mistake people make is focusing too much on the purchase price and not enough on interest rate. A lower priced home with a bad rate can cost more monthly than a higher priced home with a better rate. That's why credit score, debt level, and timing all matter. Small differences in financing can have a huge effect on what feels affordable month to month. And then, of course, there's the emotional side. People shop for homes based on feelings. They imagine their future. They picture holidays, backyard barbecues, the perfect office, the extra bedroom. And that's fine, but the mortgage payment doesn't care about your vision board. The smartest buyers I know don't buy the most house they can get. They buy the house that leaves them room to keep living well after they move in. So if you want the simplest answer possible, here it is. If you make $40,000, think carefully and stay conservative. If you make $60,000, homeownership may work, but only with discipline. If you make $80,000 to $100,000, you've got options, but don't confuse options with permission to overspend. If you make $150,000 or more, you still need boundaries because higher income doesn't protect you from bad decisions. The goal isn't to buy the biggest house. The goal is to buy a house that supports your financial life instead of draining it, because the best home is not the one that impresses people online. It's the one you can afford comfortably, sleep peacefully in, and still have money left over at the end of the month. That's real affordability. Most people don't buy too little house. They buy too much. And it usually happens in a completely predictable way. First, they look at listings just for fun. Then they fall in love with homes slightly above budget. Then they talk to a lender who gives them a maximum approval amount that feels surprisingly high. And from there, their budget quietly shifts upward until the question is no longer, what can I comfortably afford, but how do I justify this monthly payment? That's the problem. Because when it comes to housing, the biggest financial mistake is not underbuying. It's overcommitting to a payment that looks manageable on paper, but becomes stressful in real life. So let's talk about how much housing you can actually afford by salary, and more importantly, how to think about it the right way. A good starting point is the 28% rule. That means no more than 28% of your gross monthly income should go toward housing. If you make $70,000 a year, that's about $5,833 a month before taxes. So your housing payment should ideally stay around $1,633 or lower. If you make $120,000 a year, that's $10,000 a month gross. So your target housing payment is around $2,800. Simple enough, but even that rule can be too aggressive depending on your life. Why? Because gross income is not spendable income. Your real life runs on take-home pay. And if you live in a high-tax state, contribute to retirement, pay for health care, or support a family, your actual monthly cash flow may be a lot lower than you think. That's why two people with the same salary can have completely different housing budgets. Now add in debt. Let's say you make $90,000 a year, but you've also got a $500 car payment, $300 in student loans, and $200 in credit card minimums. That changes everything. Technically, you may still qualify for a certain mortgage, but your margin for error gets much smaller. One unexpected expense, one job interruption, one major repair, and suddenly you're under pressure. This is why affordability has to be personal, not theoretical. And then we get to the hidden costs. The things nobody gets excited about during a house tour: property taxes, insurance, maintenance, appliances, pest control, landscaping, closing costs, furniture, repairs, utility bills that jump because now you're heating and cooling a much bigger space. These are real recurring costs, and they can make a reasonable mortgage payment feel a lot heavier than expected. A lot of first-time buyers make the mistake of thinking, if my rent is $2,000, then a $2,000 mortgage should feel the same. Not even close. Rent is usually the maximum you pay each month. A mortgage is often the minimum. That difference matters. So how should you think about affordability by salary? Here's a practical framework. If you make under $50,000, you need to be extremely careful. Homeownership may still be possible in some areas, but only if the numbers are very favorable and your emergency fund is solid. Stretching into a house too early can slow down every other financial goal. If you make $50,000 to $80,000, you might be in range for entry-level ownership depending on the market, but your margin is still limited. A down payment, low debt, and decent credit become especially important. If you make $80,000 to $120,000, you probably have more flexibility, but that doesn't mean unlimited freedom. This is where people often make emotional upgrades that look harmless but create long-term strain. A slightly nicer neighborhood, a bigger kitchen, a newer build, all of that adds up. If you make $120,000 and above, you may have strong buying power, but you're not immune to becoming house poor. In fact, higher earners sometimes overspend the most because they assume a large income will solve every problem. But if your monthly obligations rise just as fast as your income, you're still trapped. The smartest question to ask is this: after I pay for housing, what kind of life is left? Can you still invest consistently? Can you handle a surprise $3,000 repair? Can you take time off if needed? Can you go out, travel, help family, or enjoy life without guilt? If the answer is no, the house is probably too expensive. And honestly, that's what financial success is really about. Not the biggest mortgage you can qualify for, but the amount of freedom you keep after paying your bills. So, yes, housing matters. It can be a great long-term purchase. It can stabilize your expenses, build equity, and give you control over your space. But it only works well if you buy from a position of strength, not pressure. The house should fit your budget so well that normal life still feels easy. That means leaving room. Room for mistakes, room for emergencies, room for investing, and room for peace of mind. Because a beautiful house with constant financial stress attached to it is not a win. A slightly smaller house with breathing room in your budget, that's probably the better deal. So how much housing can you actually afford by salary? Enough that you can pay for it comfortably, maintain it responsibly, and still build the rest of your life around it. Anything beyond that is usually just financial pressure wearing nice countertops.